The Inside Network in brief. Welcome to Blair Reid, Senior Portfolio Manager at Bluebay Asset Management for multi-asset and income.
Good morning, Laurence. How are you?
Very well. So you've had a little chance to reflect with the whole team on the activity, a really successful event over in Queenstown, our Investment Leaders Forum. What were some of the learnings that your team was able to take and yourself from the conversations that were happening from a really rich, diverse cohort of advisors, consultants, and academics across the wealth management in Australia and in New Zealand?
I think my takeaway, Laurence, was, which is true in investment markets as well, is the spectrum of different views at this juncture. And what is quite clear is the global economy has gone from a very low rate environment for a long time to very sharply a high rate environment. And quite rightly, I think a lot of advisors, investors, asset managers like us are reflecting on that and thinking about what is the best place to be in markets for that next decade. So I do see quite a pivot here for a lot of investors, not necessarily fundamentally changing everything, but certainly changing the mix that they have, and reflecting on some of those conversations. I think changing that mix and how to change it and what to get exposure to was really a key takeaway for me in terms of that, as you said, that spectrum of views across a large group of people.
It's incumbent on me to ask then what your view would be the next 12 months, setting us up for a decade that's potentially quite different.
Well, I am biased. Working as a bond manager, I have a certain lens, and certainly part of the presentation I made was about trying to orientate more people towards the bond market. I mean, it's called fixed income for a reason. For a long time, there wasn't a lot of income in fixed income, so that made it a little bit tough. And today it's very different. And I think for investors, I think the thing to reflect on is if you just look at cash rates, you've got cash rates that are now much, much higher than they've been in a long time. For some investors, that'll be enough. The next step up is really my world, which is bonds, which is effectively doing better than cash rates by a few percent, taking a little bit of credit risk to do that, but risk adjusted, still very attractive opportunities. And then beyond that, you have equities. So I see particularly a lot of Australian and New Zealand investors very, and this is I guess a European or a London view where I'm based, very much equity heavy. And Europe has typically been not more bond heavy, but a lot more bonds in the mix. So I'm hoping that more investors skew, I guess, some of that marginal money into the world of bonds. And I think one attraction for that market is the yields on offer today. So in some parts of the market, you have almost double-digit yields, which is something we haven't had for a long time. So we certainly see some investors thinking about allocating, not necessarily out of equities to bonds, but it can be out of all different asset classes, but increasing that bond exposure over time. So that would be my hope, and time will tell whether that hope is realized.
And touching on the challenges of looking at the current environment, one of the conversations we heard was this potential wave of defaults. Is that something that you think investors should be factoring in to their thinking?
So in the world of credit or the world of bonds, there is very safe bonds, AA, AAA, etc., all the way down the spectrum. So you have a whole panoply of risks. Certainly for some bonds with their very lowest credit rating, there are risks of some defaults, but it is certainly not my, or I think many investors' expectations that we're about to see a wave of defaults. Now, if you'd asked me at the very beginning of this year, would I expect a recession? Would I expect things to be tougher by the mid-year point? The answer would be yes, and I think that's true of nearly all economists. So what is different perhaps this time is, despite an extremely sharp rise in rates, the resilience of the consumer, the fullness and richness of the labour market, and that just hasn't translated generally into a lot of defaults. So will some defaults come? They will. That's probably a story. That's an interview for probably 2024, I suspect, and maybe even pushing into 2025. In the very short run, if we look at something like the US, there's not an awful, we think about in bonds wall of maturity. When do these issuers have to come back and borrow? That's typically a pinch point of problems. But luckily for a lot of them, that point of borrowing is a couple of years off. So a lot of these problems are stored up perhaps for the future, but it depends what happens in something like the US economy. And I think the US economy is certainly the bellwether of what everybody looks at. And it's a very open question at the moment whether 5.5% in terms of rates is enough to get inflation back to 2%. And monetary policy operates with, unfortunately, a very, very uncertain lag. And our perspective is we wouldn't be surprised if inflation does get stuck in the 3 to 4% range, so struggles to get back down to that 2. And that could mean rates at 6. And so in that circumstance, you probably would see a few more companies perhaps default there. But for the Fed, they're going to be under pressure, coming up to an election year, not to tip the economy into recession. So perhaps the most likely scenario these days is US rates remain unchanged for perhaps 12 months. That won't lead to that wall of defaults. I think you're probably going to have to see unemployment probably higher than 4.5%, inflation less than 3%, to get rate cuts in the US, and that perhaps is a long way off. So a long rambling answer. Apologies to your question, but there's a lot that really feeds into whether you're actually going to see any meaningful pickup in defaults or not.
No, great answer. And we're interested as well about that resilience. A lot of investors, through their advisor, are looking to make sure that in retirement they have steady income. What are some of the characteristics that go into building a resilient portfolio?
So the fundamental trade-off, I think, of resilience versus income level is credit quality. So the higher the quality, the lower the income. And I think for investors, it's really striking that balance between how much income can I get without incrementally taking a lot of risk, a lot of credit risk. And different investors approach it in a different way. And again, my lens that I look through is, we manage income type products across the credit quality spectrum. The sweet spot, I think, is really just on the edge of investment grade. So often BB plus for those familiar with credit ratings, BBB minus is the end of investment grade, ever so slightly down one BB plus is where you tend to get quite a big pickup in yields, but you don't get a tremendous pickup in probability of default. So that's the type of place where you can typically achieve something like cash +4, cash +5 in terms of those types of yields you can get. And that's, I think, an attractive place to be. But in terms of that portfolio and how we've approached it this year, we've gone up in credit quality. So in a world that's a little bit more uncertain, that kind of long-term average of just outside investment grade, ourselves, I suspect other investors as well, have typically moved up into the investment grade space, just in case. So it does cost you a little bit of yield, but it adds to that level of safety. And I think what investors want overall, if you do think about the very long term and no one knows what the future holds, ultimately you just want a portfolio or an approach that somehow builds in flexibility to change. We don't know what's going to happen in 3 months. We don't know what's going to happen in a year. Something that can flex to whatever is happening in those periods, I think, is going to be absolutely key for the long term.
So we've had a couple of weeks to digest all of the conversations. What would you hope when people reflect on your contribution, Blair, was their key takeaway from your insights?
So my hope would be just that they thought about income, the levels of income, how to get income. It's very common in many markets, including Australia, to seek income from equities, from dividends. And if we look at how dividend rates have changed over the past decade, they're broadly unchanged. If you look at how the returns or coupon from or income from bonds has changed over the past decade, it's changed a lot. So what we would say is, if you look at a bond, whether it's from a company or a government, they effectively have to pay you the cash flows unless they default. And we call it contractual cash flows. Dividends are not contractual. So I think for investors wanting some surety or some certainty about that future income, I'm not saying replace the equities or not seek dividends from equities, but having some part of the portfolio where you actually know what the cash flows are coming in. I think as more and more people retire and the baby boomers move through and there's more demand for income, I can see that playing a more meaningful part in investors' portfolios than perhaps it has hitherto.
Well, there's a lot happening, and as you've touched on, I think the conversation will be different in 2024. So we hope we can host you again and get your insights then.
Indeed. Thank you very much, Laurence.
Thanks, Blair.